Hello, welcome back to BJ. In the past three videos, we talked about financial statements and we talked about the three financial statements, which are the income statement, the statement of cash flow, and the balance sheet. And we talked about how they are applied in the business world. Before we move away from this area, I want to talk about a particular metric, or should I call it an indicator, that is used to also, analyze the financial performance or the operational performance of an organization. And this is called EBITDA. EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. So let's talk about the different elements of EBITDA. Earnings is like income, right? In this case, after you remove some expense. And then we have before, that means before something, something that precedes something. And then we have interest, which is the money you pay to your lenders, to your creditors, for the money they lent to you, right? And then you have to pay this money over a period of time before you pay the principal. And this is based on the agreement you have with the creditor. And then we have tax. And tax is the money you pay to the government, right? You pay your taxes to the government. Everybody knows that. And then you have depreciation. Depreciation is when there is a reduction in value of your tangible asset. We can have tangible asset or intangible asset. So when there's a reduction in value of your tangible asset, which is the asset you can see and touch, then that is depreciation. For example, the machines that you use for your production is a tangible asset, and the value will reduce over time as you use this machine, right? But when there is a reduction in value of your intangible assets, then you call it amortization. So intangible assets can be your patent, right? The exclusive right you have to an invention you made that other people cannot copy over a period of time, perhaps 20 years. Trademark rather, copyright, and also goodwill, which is the reputation of your organization. These are intangible assets. So when there's a reduction in the value of this asset, you call it amortization. So how do we apply EBITDA? Why is it important? Why is it better than net income? First, when you are comparing two organizations within the same industry, it is not fair to use net income because net income does not take into account the capital structure of the organization. And what do I mean? An organization can either be funded with debt or with equity. So if you fund it with debt, it means that you have to pay interest expense, right? And you have to remove the interest expense from your revenue and from your income before you get to your net income. We talked about this in the income statement. So it means that if I have more debt than another, if my organization has more debt, like in our capital structure, we have more debt than another organization, we are going to have higher interest expense, and so we are going to have a lower net income. So another organization that has less debt, maybe more equity than us, will have more net income if we keep other factors equal, right, than us. But that does not mean that they are performing well financially. That does not mean that our operational activities and our operational income is not higher than their own operational income. That is why EBITDA helps you to compare based on the operation of the activities without factoring in things like depreciation, things like interest, things like taxes and amortization. So it helps you to compare two organizations. At least it's a better way of comparing two organizations within the same industry to know which one is performing better. And if you take their EBITDA over a period of time, you can know which one has been performing better and the trajectory at which they are moving and which one will be performing better in the future. Also, it helps you to know the value of an organization, especially when you want to buy an organization. So if there's going to be a merger and acquisition, right, and you are doing the valuation of the organization, it means that you want to know the overall value of the organization, and if if the organization is undervalued or is overvalued, you can quickly know, because you can compare their EBITDA over the years to another organization's EBITDA or to the industry standard, to know that no, this cannot be right, this is too much, this value is too much, or this valuation is too low because of the EBITDA. Because EBITDA does not care about the size and does not really care about the capital structure of the organization. So when you want to make this kind of decision, simply by looking at the EBITDA, you can quickly know if a company is overpriced. Another application is when a creditor wants to lend money to an organization. You want to know their EBITDA, right? So that you can know how well they are generating cash flow from their operating activities and how well they are able to meet their short-term obligations. So if you look at the EBITDA, you can quickly say, especially if you also compare to the industry average, right? You can quickly say, no, these people are not performing well financially. So if I borrow them money, if I lent them money, they may not pay me back. And people don't want to give money to people who cannot pay back their money. Because it's too stressful. You have to be chasing them around, and you can even lose money in the process. So you want to lend money to people you are very sure that they will definitely pay back, because they are generating income from their business activities. So that's another way you can apply EBITDA in decision making. So now I hope you understand the meaning of EBITDA. And if anybody asks you what is EBITDA, you can quickly tell them the meaning of EBITDA, different things that add up to make EBITDA, and how it is applied in the business world. So thank you.